Welcome everyone to our webinar today called Understanding the Main Street Lending Program Funding Forward. Please post your questions in the Q&A only. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com, and later in the day we will also be emailing a copy to participants. Briefly about myself, I am the founder and CEO of MultiFunding. I am an Inc. columnist writing on business lending issues. I have advised the White House, former administrations, as well as the Federal Reserve on business credit markets. I have a book out on Amazon called The Growth Dilemma, and for my entrepreneur organization friends out there, I'm a member of EO Philadelphia. My lawyers asked me to share some disclaimers. We are in an unprecedented time in history, and the information we are sharing is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be reimagining our businesses and thinking about what is next. About rebuilding our businesses, getting them healthier and stronger is like preparing for a battle. And in any battle, you need a strategy. Do you plan to pivot your business 5%, 50%, or 90%? What will your team look like going forward? And how much cash will you require for your business? Cash is like ammunition, and in any war, you need ammunition, and you need it for offensive and defensive purposes. How much cash will be required to get your business back on a stable footing? What is the best case and worst case situation? And where will this cash come from? And what opportunities will you consider? And what does your future look like? These are the issues that I'd like you to consider for the Main Street Lending Program that is now open. It is part of the CARES Act and has $600 billion allocated for it. It is in effect until September 30th, 2020, and is comprised of 3 facilities: the new, the priority, and the expanded. Context is important. The Main Street Lending Program is not an entitlement program like PPP. These are loans and you have to pay them back. They will not be forgiven. Therefore, it is tougher to get them, and the underwriting criteria are more stringent. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank, assuming they are participating. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live, but let's be clear that most banks are still sorting through their credit policies and procedures and are not 100% ready yet. There are a few are, and many are working hard to get ready, but it takes some time. And while the Federal Reserve has produced a list of lenders on the Federal Reserve website who are purportedly taking new customers to the program, the list is not complete and not accurate. Existing lenders will use this program to consider adding additional debt to their clients to give companies more runway and protect their current liabilities. And new lenders were looking for strong credits and new banking relationships. If you will be looking for a new loan through a new lender, you will almost certainly be asked to give them your banking relationship. And you'll get through these through one of your loans. There are approximately 300 to 400 banks across the country who are participating in the program. To be eligible for the program, your business must be established prior to March 13th, 2020. If you have more than 15,000 employees or more than $5 billion of revenue on a consolidated basis, you're too big, and you have to be created or organized in the United States. Let's talk about the US eligibility test. You have to have greater than 50% of your assets in the United States, annual net income generated in the United States, and annual net operating revenues generated in the United States in order to qualify for the program. Subsidiaries of foreign companies can apply as long as they attest that the money will not go upstream to their parent companies abroad. Eligible business types include partnerships, limited liability companies, corporations, associations, trusts, cooperatives, a joint venture with no more than 49% participation by foreign business entities, or a tribal business concern. The Federal Reserve is working on a separate program for nonprofits, but it is not operational yet. Ineligible borrowers include developers and landlords, and certain list of other industries, including private equity firms, gambling companies, sex companies, etc. Affiliation rules apply. An affiliated rule of companies can't participate in only one Main Street facility, and the affiliated group's loan cannot exceed the maximum loan amount for that facility. Now let's dig into the three facilities and start with the new and priority facilities. These loans share commonalities. They are secured or unsecured. They have a 5-year maturity. Principal payments are deferred for 2 years and interest payments are deferred for 1 year. The unpaid interest will be capitalized. You pay 15% at the end of year 3, 15% at the end of year 4, and a balloon payment of 70% at the end of year 5. They are priced at an adjustable rate of LIBOR plus 3%. If you're modeling the loans, you can count on them being approximately 3.31% at this time. Prepayment is permitted without penalty, and there are fees to get in between 1% and 2%, but most likely in all cases, they will be 2%. That can be taken from loan proceeds. The new facilities range from $250,000 to $35 million. How does it work? They're the basis of 4 times your 2019 EBITDA minus your existing debt. So as an example, let's take row 3, a company with $500,000 worth of EBITDA. The maximum facility they could get would be 4 times that, or $2 million. However, if that company had existing debt of $1.5 million, their potential new money loan would be $500,000. That same company in row 1 with existing debt of $500,000 could qualify for a potential new money loan of $1.5 million. In case of bankruptcy, what happens with the other lenders that you have, pre-existing lenders that you want to coexist with your new Main Street lender? In case, what you have to negotiate with them is that in case of bankruptcy, they will share the same rights as your new Main Street lender. However, in the normal course of business, the new lender's rights can be subordinate. These loans can be secured or unsecured depending upon the liens that your other lenders have. And you are allowed to take out additional debt after you get the loan, as long as that lender's rights don't interfere with your Main Street lender's rights. The priority facilities go bigger. They start also at $250,000, but they go as high as $50 million. And these are a multiple of 6 times EBITDA instead of 4 times EBITDA in the first loan. So take as an example, row number 3, the same company with $500,000 worth of 2019 EBITDA. And that company could get a priority facility for up to $3 million. If that company had existing debt of $1.5 million, their potential priority loan would be $1.5 million. That same company in row number 1 with $500,000 worth of existing debt could get a potential priority loan of $2.5 million. What's unique about the priority facilities is that you can refinance debt with other lenders into your priority facility. The lender's rights have to be senior or on par with all other lenders except for the mortgage. So the lender's rights in the priority facility are higher than they are in the new facility. And these can be secured or unsecured depending upon what other debt there might be and what you're able to arrange with your lender. The expanded facilities are a little bit different. They start as, you have to, at a minimum of $10 million and go as high as $300 million. How do they work? Well, let's take as an example in row number 2, a company with $10 million of 2019 EBITDA. The maximum expanded facility they get would be 6 times that, or $60 million. If that company had already had $50 million worth of existing debt, their potential expanded money loan would be $10 million. These loans really operate in many ways in the same ways as the new and the priority, except the rights, tag-along rights with the existing lenders, and the fees to get in are a little lower, from 0.75 to 1.5 bips. To get these loans, you agree that you will not use the money to repay other debt, unless in the case that you refinance other debt as part of the priority facility. You commit that you will not reduce other lines of credit or cancel them, and you attest that you have no reason to believe that your company will go bankrupt in the next 90 days. While you have these loans, you can repay a line of credit, including a credit card, in the normal course of business. You can take on additional debt or pay additional debt, as long as they does not interfere with the core rights of your Main Street lender, and you certainly are allowed to refinance maturing debt. You agree to certain compensation restrictions. There are exceptions for S corporations or other tax pass-through entities that in order to meet your tax requirements. While you have the loan and for up to 12 months after the loan is paid in full, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you cannot earn more than that while you have the loan and for 1 year thereafter. If you earn $6 million, what you do is you take the difference between 3 and 6, 1.5, you add that to the 3, and you get a base compensation limit of $4.5 million. You agree to make reasonable efforts to retain your employees while you have the loan. But unlike PPP, the priority here is to retain the company, not necessarily the employees. Your lender, if you're going to an existing lender that you've already used, they will calculate your EBITDA in a fashion similar to how they've done it previously. If it is a new lender, the lender will be required to calculate your EBITDA the way they've done it for companies like yours previously. Your debt will be calculated on the date of your application and will include all existing outstanding and undrawn available debt from private and bank lenders. If you have an asset-based line secured by accounts receivable and inventory, this amount will be just amount actually borrowed, not the amount that you could borrow. How do you pick between the new, the priority, or the expanded? Let's take an example, number 2, a company with $4 million of 2019 EBITDA and $10 million of debt on the date of application. They could potentially get a new facility of 6 or a priority or expanded facility of 14. They would have to evaluate what rights they can work out with the lenders, which lenders are participating, and really how much money they needed. I thought I'd share with you 3 case studies about how borrowers are planning on using these loans. One is a company with a $3 million line of credit and $1 million drawn. This line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity. They would rather not draw down their entire line. Example number 2 is a professional services firm whose partners will reduce their draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much cash will you require to get your business back on a stable footing? What is the best case and the worst case scenario? And where will the cash come from? And what does your future look like? And what opportunities are you considering taking advantage of? Those are the prepared slides I have. And now it's our pleasure to open up the floor. Please post your questions in the Q&A instead of in the chat box. And the moderator will read them to me, and we'll be happy to go through whatever questions that you have. Thank you so much.
Thank you, Ami. What banks are providing MSLP loans without personal?
What banks? Go ahead, Heather. While the personal guarantees are not a requirement of the loan programs, there are just a handful of banks who are willing to do this loan in unique situations without a personal guarantee.
What about hiring senior new officers?
That's a good question. You could hire them with a minimum salary of $425,000 Are there exceptions for hiring them for salaries higher than that? Something I'd have to look into. I'm not sure.
Is there a minimum loan amount?
The minimum loan amount is $250,000. However, to be realistic, most lenders are not going to do this program for loans under $1 million.
Does the state of Hawaii have banks who are participating?
There are none that I'm immediately aware of, but it's certainly something we could research and look into.
Can you talk about the chances for the Fed to issue new program for smaller businesses?
I hope there will be a new program. However, it's unlikely it will come from the Fed. It will most probably come from the SBA.
Do the two basic and priority loans limit S Corp distributions to shareholders?
All of the loans limit distributions to shareholders.
Is there a list of banks processing without PGs?
There's no active open list of banks processing without PGs. And again, that's on a highly individual basis. Of all the clients we're working with on the program, there are only 2 of them that we might, at this time, might have a chance of getting done without a personal guarantee.
Do all loans have 5-year term?
Yes, at this point.
Do you think a new program like PPP might come out again?
I think that it's highly likely that there will be additional relief programs. It's unlikely that they will look anything, in my opinion, similar to the PPP program. And it's unlikely, in my opinion, that much of it will be, if any of it will be forgiven.
Thoughts on whether this program will be extended beyond September 30th?
I think that it is highly likely that it will be, that it will extend beyond September 30th.
Can the owner use the MSLP money for other investments as long as they are paying this loan off?
There are few requirements about restrictions on the money. However, I'm certainly there will be covenants in the loans that as long as they are investments inside the company, you can't pull the money out of the company and then make investments separately.
Please review details of limitations regarding distributions to shareholders.
Kevin, there's some clarity for this. It is any shareholders can get distributions to cover their tax basis while they have the loan and for 1 year after. There's an open question if there were distributions to shareholders historically, if those can be matched in future years, and especially if those are employees who also get a K-1 like owners, and we're waiting for clarity on that.
Are there 2 banks which are processing loans without personal guarantees, and is there a list of participating banks?
Yeah, it said that the public list of participating banks is available on the Federal Reserve's website. And in terms of the 2 banks that are doing the loans without personal guarantees, that's not information that we publicly share.
Is there a fee to apply?
There's no fee to apply with the lender. However, if the loan is completed and processed, you will pay 2 points plus any legal fees or title search fees, etc., with the loan. Happy to take any other questions you have, folks.
Can we reach out to you to work with the banks not requiring PGs?
You certainly can, but again, I just want to reinforce to everyone that company has to be exceptionally strong and stand on its own for a bank to possibly consider one of these loans for them without a personal guarantee. And there are a few banks that are willing to do it, but we're happy to discuss it.
Why do you think banks have been hesitant to participate in this program?
It's new and banks have a PPP hangover. Banks do not stand to make much money on this program for new clients. And banks, there's a lot of logistics that have to be worked out. The banks are in the process of working through it, but it takes some time. It's nothing simple about these loans.
You said landlords were ineligible. How does that work with an affiliated group? Is the real estate company considered part of the group for loan amounts?
No, if it's an affiliated groups and you hold the real estate in a separate entity, that debt doesn't get counted in your total loan amounts. Happy to take any additional questions, folks.
What kind of collateral are the banks looking for this loan?
It really depends on what the type of loan is and the overall performance of your company. So there's no clean answer about that.
Would you suggest us apply if we apply for 500K?
It really depends if you have existing debt with a lender who's participating. In that case, they might be happy to do the $500,000 loan. If that is not the case, it might be smarter, depending on how your company is doing, to use an SBA loan instead of a Main Street loan.
I assume banks are reluctant since borrowers will want to refinance existing facilities at a lower rate. Do you agree?
Yeah, but it's not, your bank cannot refinance your existing loans with them into a Main Street loan. So if you want to do that, you would have to take that to an entirely new lender. The banks are reluctant because they are nervous. They don't, the yields are low, and they are nervous that the yield is going to keep changing and the goalposts will keep changing like they did with the PPP.
If you get an EIDL, are you still eligible?
You're not ineligible, but there's a good chance you will have to if you have an EIDL, because of the way the liens work on the EIDL, you will have to take the preferred facility and refinance EIDL into the facility, which means you're trading some 6-year money for 5-year money. So that trade-off has to make sense to you.
Any estimate on length of time to proceed and approve these loans?
I think from start to finish, it will be a 6 to 8 week process.
What % of banks do you anticipate will be participating? And what is your sense of the type of lenders? Small, local, large only?
That will really be, I don't think there'll be more than 300 to 400 banks participating, and it will be a mix of large and regional.
Will the banks accept capitalized R&D adjustments as EBITDA add backs?
And each bank has to use their own procedures and history with evaluating EBITDA. So if it is a bank that you've worked with historically and has lent to you historically, they have to follow the exact same EBITDA calculation that they have historically on their books. And if it is a new bank, then they have to do it in a way they have done it similarly for companies like yours before.
Any more questions, folks?
Happy to take them. Going once, going twice. If we will have questions you'd prefer to answer in a private setting, you can feel free to email us. And I know that this is a lot of information and fairly confusing. We've tried to simplify it for you. We wish everyone Godspeed and God bless, and keep pushing forward on your journey and fighting through it. That's why I chose my Zoom background of a fighter jet for you today. So thank you so much for your time, and we'll speak with all of you soon. Take care now. Bye-bye.
Thank you, Ami.